Hi, I'm Larry DeBoer, Professor of Agricultural Economics and Extension Specialist with Purdue University. The property tax raises over $6 billion a year to pay for local government services. Schools, counties, cities and towns, townships, libraries, and other local units receive a large share of their revenue from the property tax. If we're going to tax property, though, we need to know its value. Just what are we going to tax? This is a problem. The only time we really know what a property is worth is when it's sold, but most property doesn't sell every year. We solve this problem by electing assessors to estimate the value of property for tax purposes. How these assessments are done is the subject of this video. Let's start with a basic question. What is an assessor trying to do when he or she puts a value on property? In the Town of St. John case in 1998, the Indiana Supreme Court established a standard for Indiana property tax assessment. To paraphrase, they said that assessments should be based on objective measures of property wealth. We try to meet the court's standard with a system called market value in use. For most property, assessments are predictions of the selling price of property if it was sold in a market to a disinterested stranger, and not your lazy brother. And so, we want to estimate the market value of property that hasn't been sold recently. But how? There are three basic ways. Let's hear about that next.
The first method for estimating property values is the sales comparison approach. We find properties that sold and build equations that relate selling prices to property characteristics, like square footage, condition, number of baths, and so on. This is a process that works well for residential properties because they all have similar characteristics and there are usually a lot of sales. But what about commercial and industrial property with very different characteristics and few sales? Assessors generally use a cost approach. They figure out how much it would take to build the business at current building prices and subtract depreciation. Then they add the value of land. For properties that generate income, like farmland and rental property, we take the income and divide it by a rate of return. The result is the amount that a reasonable investor would pay for an asset with that income stream. Indiana also taxes personal property, which is almost entirely business equipment. Personal property is assessed by its owners using the cost approach. They record the cost of equipment and subtract percentages based on age to account for depreciation. Personal property assessments are subject to a floor. The assessed value of a business's personal property can't be less than 30% of its original cost.
Property values change all the time and assessments need to keep pace. So we adjust values each year, a process called trending. Assessors keep track of selling prices, costs, rents, and income, and use this data to adjust assessments each year. We started trending property in 2007, just in time for the big recession. Before the recession, property values were rising, and trending picked up the increases. For taxes in 2007 through 2010, most counties saw increases in assessments of 2% or more each year. Then the recession took its toll, and by 2009, property values had dropped a lot. That price information was used for trending assessments in 2010, and taxes in 2011 were based on those assessments. Here's the map of assessment changes for taxes in 2011. Most counties saw assessed value decreases. So the drop in property values in 2009 affected tax payments in 2011. There's a 2-year lag between changes in property values and the effect on tax bills. As the economy recovers, new construction and increases in property values should raise assessments and affect tax bills, with a 2-year lag. Indiana has conducted statewide reassessments every 6 to 10 years. In a reassessment, property is inspected and its characteristics are re-recorded. New construction or property improvements that might have been missed are discovered and errors are corrected. New costs and prices are applied to these characteristics. This used to cause huge changes in assessed values. 6 to 10 years of property price inflation would be incorporated into assessments all at once. Reassessment would cause big shifts in property tax bills, too. Usually homeowners would pay more. A statewide reassessment was completed in 2012, and the new assessments were used for tax bills in 2013. It was the first reassessment since trending began. Trending cut the big reassessment jump into small pieces and spread them among the years between reassessments. In the 2013 reassessment, for the first time ever, assessed values actually went down statewide. The reassessment for taxes in 2013 may be the last statewide reassessment in Indiana. Starting in 2015, counties will move to a 4-year cycle and reassess 25% of properties each year. The other 75% will be trended, so cyclical reassessment shouldn't put the newly reassessed fraction of property at a tax disadvantage. It should help assessors spread out the work and the costs of reassessment more consistently. Only part of the assessed value of property is taxable. Deductions are subtracted from gross assessed value to get taxable assessed value. There are many kinds of deductions for veterans, disabled people, people 65 or older, for installation of energy-saving technology, and several others. Some businesses receive abatements, so only a fraction of their property assessment is taxed. Abatements are intended to encourage new investment and expansion. But homesteads get the biggest deductions. A homestead is an owner-occupied primary residence. Rental apartments or vacation homes don't qualify. Suppose a homestead is valued at $120,000, which is a typical value in Indiana. The homestead gets a $45,000 standard deduction subtracted from its market value assessment. It also gets a 35% supplemental deduction subtracted from the remainder. That's $26,250 for this house. And most homeowners get a $3,000 mortgage deduction too. After deductions are subtracted, the taxable assessed value is $45,750, less than half the gross assessment. Deductions are the main way we deliver property tax relief to homeowners in Indiana. Here's a chart showing assessed values by property type for all of Indiana. The dark green bars show gross assessed value, the light green are taxable or net assessed value after deductions are subtracted. In total, only about 2/3 of gross assessed value is taxable. That's because of deductions. But look, homesteads get by far the most deductions. Homestead taxable assessed value is reduced by more than half. Businesses see smaller reductions, mostly from abatements. Agricultural property and other residential, which is mostly rentals, get almost nothing in deductions. Taxable assessed value almost equals gross assessed value for those property types. After all the deductions, business, real, and personal property has the highest share, with homesteads a close second. Less than 1/3 of taxable assessed value is other residential and agricultural property. This varies quite a bit by county, though. Here's a map showing the highest property share in each county as measured by taxable assessed value after deductions. That's why there are so few blue counties where homesteads are the largest share. Those big homestead deductions really reduce homestead taxable assessments. Homesteads are most important in many suburban counties, though. Agricultural property, shown in green, has the smallest share statewide, but in plenty of rural counties, ag is the largest part of the tax base. Other residential is largest in a handful of counties, colored red, like Brown and Steuben, where there are a lot of vacation homes and rentals. In most counties, though, business property has the biggest share. Most of the map is shaded purple. Indiana makes efforts to promote correct assessments. County and township assessors are among the few elected officials in Indiana who are required to obtain training if they want to continue in office. Counties complete an assessment ratio study each year, which must be approved by the state's Department of Local Government Finance. The study compares assessments to sales prices to see if they match. Assessed values are intended to be predictions of selling prices, and most property owners have an idea about the value of their property. That means that property owners can audit the assessor. If a property owner disagrees with an assessment, he or she has the right to appeal. Appeals start on the local level, first informally with the assessor, and then to the County Property Tax Assessment Board of Appeals. And yes, it's called by its acronym, the PDBOA. From there, appeals go to the Indiana Board of Tax Review, a statewide agency, then to the Indiana Tax Court, and ultimately to the Indiana Supreme Court. Most often, though, appeals are settled locally. Is the assessment process complicated? You bet. Making predictions about the value of every parcel of property in every county every year is a daunting task that requires real expertise and no little expense. If we're going to tax property, though, we have to estimate property values. The assessment process is how we do it.